Yes.
one of you to make an opening statement, please.
Actually, we're going to do a joint one.
Yeah, absolutely.
Okay. We've tried to keep it to 5 minutes.
No, that's good.
Okay, so even if we stop emitting greenhouse gases tomorrow, we will continue to face cascading, compounding and complex disasters fueled by climate change. And as you've seen, we've seen an ongoing rise in both the severity of events and also the expenditure on recovery. If we do nothing over the next 40 years, the cumulative cost of natural disasters to the Australian economy is expected to be at least $1.35 trillion in present value terms, and that's an underestimate. We can see these costs rising before our eyes. So the $11.4 billion allocated in the Australian Government's 2024-25 budget to continue supporting ongoing recovery efforts reflects an increase of $3.9 billion from the 2023-24 MYEFO. Climate change is outpacing our ability to adapt. Government resources are increasingly strained and will be unable to meet the growing demands. The gap in insurance protection is widening, leaving more people vulnerable. At the same time, people are expecting that government will intervene post-disaster, and this very expectation influences insurance decisions and risk-taking behaviour. Incremental improvements to disaster responses address the symptoms, not always the root causes of disaster risk, and these approaches are no longer working. This is playing out across the globe, and locally we have seen the unprecedented catastrophic Black Summer bushfires and levees overtopped by devastating floods in 2022. I just want to emphasise that the best way to reduce recovery costs and close the insurance gap is to find effective methods to minimise disaster impacts in the first place, leaving much less damage to pay for. You probably know, but disasters are caused by three things: the extent of the hazard itself, our exposure to the hazard, and our vulnerability to that hazard. And to reduce disaster impacts and consequent insurance liabilities, we need to address all three. We need to harness the latest science and technology, such as that being developed by ourselves and others, to better understand the hazard and to understand how to successfully intervene. We must reduce our exposure by removing people and infrastructure from very high-risk locations. And we must reduce our vulnerability through building resilience into our people, our infrastructure and our environment. Right now, we lack the transformational solutions we need to tackle the fundamental drivers of these challenges head-on. So investing now provides us with the necessary options we will definitely need to reduce the devastating costs of future disasters. While we develop these solutions, we really do need to work out who pays for disasters and how. And this was the topic of a roundtable we recently hosted with government, industry, insurance and researchers, where we tried really hard to identify innovative solutions to this, what's starting to seem like a quite intractable problem. And we came up with some really curly research questions that probably need to be answered before we can answer the question. The first is, where are the highest risk locations across Australia, taking account of complex and compounding future risks? The second is, how can we improve data collection and sharing across not just industry and government, but academia and others, to enhance risk modelling, research and resilience building, which is in everybody's best interests? How can we overhaul land use policies to balance climate adaptation with housing affordability and urban density, and also future-proof building codes? How can the right balance be achieved between investing in resilience and allocating resources for recovery, and how do we manage that transition? How do the effectiveness, costs and benefits of various risk reduction interventions and their impact on reducing claims costs compare? And whose responsibility or responsibilities is it to pay for resilience and recovery? And finally, how can insurance be transformed to support climate adaptation, and how can premium relief provide both the right incentives for risk reduction while remaining accessible to vulnerable populations? Addressing the terms of reference of this inquiry is complex and urgent. If we can address these questions, we can make progress in what is likely to be one of the biggest challenges of our time. Thanks, Carolyn.
Associate Professor Prinsley's final two questions are crucial considerations for equitable and effective insurance solutions. I'm a sociocultural anthropologist, and I've conducted Australian Research Council-funded field research on inclusive insurance for communities internationally impacted by environmental perils such as drought, exacerbated by El Niño. Research confirms that low-income and marginalized communities are most vulnerable to climate risks, and this is also where the insurance gap is widest. My embedded fieldwork spotlights the informal insurance alternatives that step in to fill that gap. When low-income households lack insurance, I found that many turn to credit, both formal and informal, to rebuild in the aftermath of disaster. These forms of self-insurance and household resource pooling are relatively invisible in discussions of the protection gap. It's crucial to ensure that this wider suite of financial services is not predatory. They should be evaluated alongside inquiries into premiums and policy coverage. For example, there's a risk that depending on pooled family resources, including common tactics like serving as the guarantor for a loan for a family member or seeking credit on a family member's behalf, as an alternative to insurance, can create social conflict and place substantial burdens on family members. To fully capture the impact of climate risk on insurance, it's important to take a holistic view of this wider suite of non-insurance financial services and their social impacts. Finally, my research focused on novel approaches like index-based insurance, also known as parametric insurance, which has been well covered by some other submissions, as a new alternative to these informal insurance tactics. This is the fastest growing sector for micro-insurance policies globally. And in fact, 80% of recently insured farmers globally are covered by parametric insurance policies. My research suggests that, while promising, these are not magic bullet solutions. While they certainly can lower premiums and offer almost immediate payments when policies trigger, they can also, for example, lock vulnerable farming communities into unsustainable land use practices and amplify other risks, such as exposure to swings in commodity prices and over-reliance on a single crop. Thank you.